Okay, welcome everybody. It's a real pleasure to meet you here today. My name is Rakesh Shah. I have been living in London for most of my life. I've worked in the city. I remember in 1990, I was sitting in the same place you are sitting. And I was dreaming, what will be my life? What should I do? Eventually, I did a degree in computer science like you, but it was business, systems, analysis, and design. And this is to understand what the application of technology is in finance. How does it come together? From this, I started a career in investment banking. I worked in London for Barclays, BZW, ABN AMRO, Credit Agricole Indo-Suez. I was a director at Deutsche Bank. After that, I left to become independent. And many years later, after doing many things in the market, I arrive here for you today. My dream was, when I was your age, when I left university, I wanted three things. The first was I wanted to be able to put my hand in my pocket and always have some money. It's okay. The second was that I would dream that I have my own house. And I wanted to live in the center of London. And the third was that there was a girl that I once saw in a shop in London selling cosmetics, and I wanted her to be my girlfriend. So I achieved 2 out of 3. The first 2. The number 3 did not work. But this is life. So we arrive here today, and my job today is to give you the practical application of all of the theory that you will learn. You can read many books and learn everything, but the real skill in life is to be able to take something and make the application in real life for a business, for yourself, for a company, because you add value to an activity. When you add value to an activity, you get paid. No value, you don't get paid. So with this, I begin with understanding what is it about capital markets that is so important. Can you learn everything about the financial markets? No, it's not possible to learn everything, but you must learn the key skills. What is the job of somebody who is in the psychology of being in the markets? For them, it is very important to understand what is happening in the market today and how will I work in those markets. So I ask you the question, who is the most famous person in the markets today in finance? Some ideas from you. Names? Shout.
Warren Buffett.
Warren Buffett. Okay, I like because this guy is able to read the slide. So we already make some success. So here's the most famous. What is the answer? How did he do it? 4 things. Long-term investing. Take less risk. Asset allocation. And if you put rubbish into the system, rubbish will come out. Garbage in, garbage out. Okay, so this is the stock price. It's a little bit difficult to read on the slide here. But if the value in 2012 was 120, what is the value today? Any ideas? How much did it improve in 3 years? 120, what is the value today? Any ideas? Okay, today is 313. So almost within the last 8 to 9 years, the value went up by 3. It tripled in value. So the question is, how did he do it? Number 1, he is interested in long-term investing. So when you go back, I won't read all the text to you now, but I will simply give you the principles. He purchased many shares and he keeps them for a long period. Number 2, Take the minimum amount of risk possible in every activity that you do. You can use this principle in finance, you can use it in your life. For example, Warren Buffett purchased a house. He said, there is nothing wrong with this house. Maybe today I'm a billionaire, but he lives in the same house. He purchased a Volvo, if I'm not mistaken, an estate car, Volvo. He drives the same car today. I think maybe it changed because it's a long time, but for 25 years, he kept the same car. He never makes gambling bets. Even when he plays golf, somebody asked him in a story to risk $1. He said, not even $1. I never take a risk which is gambling. I only take calculated risks. Later on today, we will go through all of the ideas of the financial markets. What is a stock? What is a bond? What is a warrant? What is an option? And you will understand that in every asset class, the risk is increasing. So, what is the first lesson one must learn with knowledge? Is that you must take your first loss quickly. If something is not working, you must cut the loss. Warren Buffett's first investment, he purchased a gas station with $2,000 of his money. When it did not work out, and this was 20% of all of his money, he quickly removed himself from the situation. The phrase is, if you cannot cook, you get out of the kitchen. Which is this institution? Can anybody recognize this building? Some ideas. The most famous educational institution in the world. Which names can you give me? Somebody shouted. Any other names? Cambridge. Any other names? Okay, I tell you, you're all wrong. Why? Because Harvard was created when? Just a few hundred years ago. Oxford University was created when? In the 12th century, maybe 1280, something like this. But the University of Bologna, when was it created? Which year? When the English and the British were fighting in the Battle of Hastings, killing each other with swords and weapons, the wonderful Italians were establishing the University of Bologna. So you are in one of the finest institutions in the world. Everybody know it, everybody recognize it. Warren Buffett, his story is, he was rejected from Harvard Business School. Bill Gates, Mark Zuckerberg also left Harvard Business School. He went to Wharton, he did not like it, he went back to Columbia. But the lesson is, it is not the university that you attend, but success comes from hard work. There is no other way to succeed. Lesson number 2, history repeats itself. So from all the books that you read, the cycle repeats again and again. Which history books have you read? In computer science, in psychology, in philosophy, in economics? Anybody give me some names, please? Persons in history, books, ideas. Please tell me something. Some ideas. What happened in history for you in the world in the last 100 years? Some ideas? Okay, let's start like this. When was the last financial crisis? What was the name of this crisis? Subprime crisis, credit crunch. What was the crisis before this? Great Depression, but in between there was another rise and another crash in the science that you are studying. The big bubble, what year? Yeah, between 1999 and 2002. And the one before this? I help you. So there were many crises. So for example, in 1995, there was the Mexican peso crisis. In 1987, there was another financial crisis, the Big Bang. In which period in the Second World War, what was the name of the crisis then? What was the name of this crisis? 1929, the Great Depression. Okay, so does everyone, who agrees that there will be another crash at some point? Everybody should raise their hand because it's the cycle of life. It goes through ups and downs. Some famous names, Adam Smith, Victor Niederhofer. The more you learn about history, the more you understand the value of what you learn, the better. The secret is, do not make your mind full. Buffett was always willing to learn. The story is that the monk goes to the teacher, his guru, and they drink tea together. They have 2 cups. And the master begins to pour the tea in the cup of the student. And the tea begins to fill, and it fills in the cup, and then it's over the cup, and the tea is flowing on the table, and then the tea is flowing all over the table, all over his clothes, everywhere. And he says, Master, Master, why are you doing this? He says, it's because you must understand. If you do not empty the cup, empty the mind, is useless. I cannot put anything new inside. So make sure, you may have an opinion, you may even be correct, but to listen and learn. And Buffett is amazing at this skill. One tip he says is that it's a good idea to turn off your computer, remove your mobile phone, and spend some time just with yourself so that you can think. How did he do it? So here's the practical application. He uses something called sector analysis. What is the fastest growing sector in the world today? Technology. What is the second most important sector for technology? I give you a clue. Without this cable plugged in, what happens to the computer? Without energy, we have nothing. So we have sectors. They move in cycles. So some sectors are in contraction. Some sectors are in expansion. It is your job to know which sectors are going up right now and which sectors are going down. So in the last week of earnings in the United States, which sectors for companies had the highest earnings and which companies had the lowest reported earnings growth? I ask the question again. We are talking about the growth of earnings for a company. A company makes profits. Another company makes profits. We compare the 2 companies. In the USA, technology companies reported earnings here, but utilities and stable companies, consumer cycle companies, reported earnings at a much higher level. So we have a shift happening in the cycle right now. Technology companies were riding high, very strong for a long period of time, and now we are beginning to see the earnings for these technology companies slowly moving lower in terms of growth. Interesting to know. How do you do this? Now, when you go back, I wish you to make a memorization of this slide. Top-down analysis and bottom-up analysis is the foundation of all analysis in the financial markets. Top-down means 5 things. Economy. Which economy? European, Asian, could be Chinese, could be Indian, American, could be North America, could be South America. Which markets? Technology, pharmaceuticals. It could be automotive. Which sector? Inside technology, is it hardware? Is it software? Is it neuro programming? What is it? Inside the sector, hardware, which company is it? Is it Dell? Is it HP? Is it another Chinese company such as Huawei? Inside the company, which company has the best management? The management, the most important person is the CEO. Which company employs the best CEO? Wonderful. You do this analysis, you create your portfolio. Another completely different method. Bottom-up analysis on the other side. Totally different approach. It says you look at every company, does not matter where from. India, China, Argentina, does not matter. You look at the fundamentals of the company. How strong is the balance sheet? How strong is the profit and loss accounts? How much growth did they have? What is the quality of the products? How much demand for the products? In the world, how many customers have the potential to use that product? I give you an example. If you compare Facebook as a company and you compare it to another technology company, for example, Uber, also a technology company, which company has the potential for more customers? Many countries do not have a big taxi service. Why? Because the taxis are only concentrated in the big cities. In some countries, more than 50% of the population is living outside of the city. So Facebook has for sure a bigger market population. So the potential for Facebook will always be higher than Uber. So this is an example of how a company can have different product strength. The last one, competition. Some businesses have very little competition. Can you name me 2 or 3 businesses that have very little competition? Companies. Google, wonderful. Another one? Amazon. What about some Italian companies? Any ideas? Yeah, Luxottico. Okay, and what are the big industries in Italy? Oh no, the big companies in Italy. Give me some names of some very large companies in Italy. Which one? Credit Italia, a bank. Trenitalia. Yeah, okay. Is it easy for another company to open up a train service in Italy? No. Okay, another type of company. Give me an example. Fiat. How many new motor manufacturing businesses have arrived in Italy in the last 1 year? The last 10 years? The last 25 years? Can somebody name me a new automobile organization that opened in Italy in the last 25 years? No. So what kind of company do we call this? Begins with the word M. Monopoly. Duopoly. Oligopoly. These are names for businesses. For example, Google is a type of company that could be considered a monopoly. Could be. It depends on your perspective and what you think. Because there are other services. DuckDuckGo. There is Yahoo. There are other competitors, but they are much smaller in size. So it's important for you to understand the difference between both. Okay, so what has happened in the world in the last 100 years in terms of economics? Corporations have become bigger and the state has become smaller. In 1907, if we were having this discussion, we would be asking the question, if I am an investor, should I put my money in Argentina or the USA? Because both of these countries were roughly similar in prospects. The USA was in the north, and Argentina was in the south, but it was the discussion happening in the coffee houses in London. Today, when I ask you the same question, you'll say, of course, Rakesh, I would invest in America. Why would I invest in Argentina if I'm looking for big companies? But the same could be said today of other nations, such as Korea, or could be Taiwan, could be India. We know that China is already ahead, but in 60 years' time, maybe one of these smaller nations is greater than France or Spain or Italy or the United Kingdom. It's very important to know. What is the life cycle of a company? So this is in Brearley and Myers, the textbook that you will read. It will tell you how to analyze the business from many perspectives, from the cash flow, from the marketing perspective, or how to evaluate the profits from customers from today moving forward for 10 years, how to look at the debt in the balance sheet compared to the amount of capital available for investment. Business school has a map that it gives to the students to explain what is the life cycle of a company. This is what the map looked like in 1960. You start the company, you have big growth, and in the end, for example, if you are a car manufacturer, such as Lamborghini, what did Lamborghini originally make? Tractors. So would it be impressive if I come today in a tractor and I come to collect the new girlfriend and say, this is my new car? No, she will say, you bring the wrong car, Rakesh. You must bring the new Lamborghini. So what changed? They were able to adapt and invent a new car that was more profitable than the Lamborghini. So in the 1980s, what was the life cycle of a company? Companies realized that if they wish to raise capital to grow, because the function of a company is to return the profits of the company to the, do you know the answer? The purpose of a company is to return the profits of the company to who? The shareholders. That is the sole purpose of every company. They must make a profit and return it to the shareholders. They must obey the rules and regulations of the country. It would be very nice if they were ethical. It would be also very nice if they treated the employees very well. But the number one objective still remains to return the capital to the company. How can you improve this? You simply, if you have a machine and you wish to make more money, you make more machines. If you are producing pasta, you have one machine. You can produce 100 boxes of pasta. But if you have 100 machines, you can produce 10,000 boxes of pasta. So the answer is very simple. You get more money for investing in the company to make more machines. In the 80s, they had a different choice, a new choice that became popular. Many companies would go to the financial markets, the stock exchanges. For example, they would go to a stock exchange such as this one, the London Stock Exchange, and they would say to the London Stock Exchange, Mr. Exchange, can you please help me to raise some money? Because I need to invest more money in my company. How will you help me? They'll say, of course, we know millions of investors, thousands of investors, funds, institutions. You do something called a stock exchange listing. Could be called an IPO, initial product offering. What is the most common type of offering today that is related to what you are studying? What is the one way that you could leave as a student this year if you had a wonderful idea between 4 or 5 of you? and you create something and you send it to the market, what would it be for you today? Give me some ideas. Say that again. Crowdfunding could be it. Yeah, another idea. ICO. What is that? Initial coin offering. Who is familiar with ICOs? Who is familiar with Bitcoin? Bitcoin. Everyone familiar with Bitcoin? So many students around the world are thinking about making their own coins and doing an ICO. Why? Because it is a way to get access to capital in the market very quickly. So in the 1980s, companies were going to the stock market and running activity to raise money, and also there was a lot of merger and acquisition activity. They would raise debt, meaning they would go to investors, borrow money, and buy many companies, do something called a turnaround, change the direction of the company, and invent themselves as new businesses. Good examples of this are companies such as Microsoft. Why? Because originally Bill Gates was working for IBM. He was a programmer. He said to IBM, you have this small software, you are not really using it, it's called DOS or Windows, which he renamed it. Can I buy the rights for this software? And I leave. They said, yeah, it's just a small software, take it and leave. And then from this software, he created Windows. And then from this growth, he became one of the greatest. He created one of the greatest companies on earth, Windows and Microsoft. That's what happened in the 80s. In the 2000s, it changed again. Why? Because we had something that Bill Clinton pushed in 1995. There were adverts in Europe from this American president called Bill Clinton, and he said, everybody get ready. There is something new coming. It's called the information superhighway, the information autostrada, the information motorway. People were confused. Why are you talking this technology? Internet is not real. People will go to the shops and buy things. Why somebody look inside a box to find something when there are real people, real places? Says, no, it will change everything. So what happened? The power of branding, global brand, changed everything. So you have in the bottom a trademark. Why? If you do not trademark your brand, you build everything and then somebody steal the name, it's gone. That's why Coca-Cola, very protective. Every brand company in the world, when they make a new product, they're very protective to trademark the name. Then you have experience, the brand experience. So when you get a new product, a new technology product, when iPhone sells you, Apple sells you a new iPhone, the quality of the box, the smell of the box, when you open it, all very important. And then the final, you end up with a global brand, which is very difficult to move because it carries a lot of weight. So what are the top 5 global brands today that you can name? Throw some names for global brands. There are thousands. Shout for me. Ferrari, yeah, it's a global brand. Another one? Google is a global brand. What about consumer products? Procter & Gamble has thousands of consumer brands. In the technology sector, what are the top 3 consumer brands in technology? Apple. Who is their main competitor? Samsung. And who is catching up with Samsung? Huawei. So it's dynamic and it's changing. Okay, so then after you get past this global brand, you have to ask the question, I think I missed a few slides. What is the method, the short-term method of finding out what is moving in the market? We will not cover this today, but there is trading, arbitrage, things called mean reversion. Many models. So you need to be able to value the markets using models. Some of the models that are not listed there, but you need to understand the capital asset pricing model. Who is familiar with this model? CAPM. Okay, by the end of November, if I come back, everybody must know this by heart. It's your homework. Which other models should you know? What other model is the most important model to know how much money you have today compared to how much money you will have in the bank account in 2030? The capital asset pricing model works on discounted cash flows. It simply means that if the rate of interest in the United Kingdom is 1% and the rate of interest in Australia is 4%, where is it better for me to put my money? In Australia, because I get 4%. But if I keep my money in Australia for 10 years, maybe the interest will be 40%. But the problem is maybe the currency will move in a different direction. So I need to do a calculation. How much is that money worth today? I need to discount it to the value of that money today. Okay, so Warren Buffett did this. He was very clever. He said, I use discounted cash flows, but I try not to work too hard. I work smart. So I find easy to understand companies. His phrase is, I don't look to jump over 7-foot bars. I look for 1-foot bars to step over. So he doesn't look for a bar that is 2 meters. He looked for a bar that is 20 centimeters. Make his life easy. Long term or short term? Which one is better? Well, the proof is that he is the most successful investor in the world. How does he do it? You must control your losses and maximize your gains. What is the principle where if you have greater wins and you make, for example, 20% per year, and you compare this with an investor that makes 5% a year, how do you compare the two? The person making 20% a year makes high risk investments. The person making 5% a year makes lower risk investments. Each year you make 20, 20, 20. The problem is when you make a higher risk investment, if something goes wrong, the loss will generally be worse. Why? Because when you make a higher risk investment, it's more dangerous. If I drive a Ferrari at 200 kilometers and I have an accident, it's going to be much worse than if I drive the Ferrari at 50 miles an hour and have an accident. The question is, if the speed is 4 times as much, will the damage be the same, 4 times as much? If I break my arm at 50 miles an hour, will I break 2 arms and 2 legs at 200? No, I will be dead. It's not the same. It's the same in the financial markets. When the loss happens in year 4, the person who makes a 5% win will probably make simply a 5% loss. But the person who makes higher risks takes a higher loss. So, although you make 20, 40, 60% returns, when you do the calculation, the final annual result over 4 years is 103. When you take somebody who makes 5% consistently, the annualized result, if you look at the calculation, gives you 109. So what does this tell you? You have to look very closely at the statistics and you must calculate them yourself. You cannot simply look, 20%, I invest there. No, you must discount the cash flows, understand how the cash flows are working year by year. So this is the 7 steps for Warren Buffett. Stocks are a business. Always increase your size and investment. reduce your portfolio turnover, meaning do not change too much. Develop alternative benchmarks. Think in probabilities. Recognize the psychological aspects of investing and ignore all of the forecasts, all the news, people tell you ideas, ignore everything. Okay, think of stocks as a business. We discussed this already. First problem. We understand, is diversification good? We agree, yes. But how much diversification? You want 1, 2, 3 companies in your portfolio, or you want 100? When is too much diversification a problem? Because the investment returns, they begin to go down. Warren Buffett says we want limited diversification. The English phrase is, do not put all of your eggs in one basket. But Warren Buffett said, maybe this is some truth in this. If you have less eggs in one basket, but good quality eggs, it is better. You will have a better return. And in the years, he has been proved to be correct. Number 2, be very confident in your financial decisions. Do not change your mind quickly. How does he do this? You must understand the dividends of a company. The dividends are the profit. You must calculate them accurately. Number 3, you must use alternative benchmarks. Sometimes the story of the company is not inside the balance sheet. It is not inside the data. For example, here I will show you the data of a company. This is McDonald's Corporation. Now, if we look at the data inside this company, we can start to look at many items. The question is, do these items tell us the full story? Let's look at what you will have to do if you analyze the company. The first data you will look at is the chart of the company. What is the market price of the stock? This is McDonald's Corporation in 2012. Then you look at the key ratios. Within the next month, you must memorize these ratios. EPS. What does this mean? Earnings per share. How much profit is made for every share in the company? A company may have 1 million shares, 25 million shares. So you must have a metric, a measurement where you can compare one company with another company. Because one company may have 1 million shares, another company may have 10 million shares. So if one company is making a profit of 1 million and another company is making a profit of 20 million, you cannot compare the profit directly. You must divide the profit by the number of shares and you will arrive at a result that where you can compare every company in the stock market equally. The next metric, we want to know, we want companies that are growing. In life, there's a law of nature described many times by many Italian philosophers, from Socrates to Plato, spoken about by Leonardo da Vinci, and that is this: in life, only 2 things are happening. Either something is growing and living, or it is dying. There is no stage in between. Something either is rising or falling. There is some illusion that you can stop time when you throw something in the air like a stone, and it stops at this point and it remains there. No. When the stone goes to the top, for an illusionary moment, it's still. Maybe you capture it in a picture. But as soon as you time progresses, even 1 second, it changes and it begins to fall. So we need to find companies that are always growing. How do we do this? We look for EPS growth. It's the second most important statistic. Why? It tells us how much profit from 2019, when we compare it to 2018, how much did the company grow? In this case, 15%. This means in 2011, in this case here, the company grew between 2011 and 2012 by 15% in the profit it made. Wonderful. What is the yield? The yield tells us for the value of your investment in this company, what is your percentage return? So if you were to put $100 into this company, your income or your yield as the shareholder investor is 2.7%. The last metric, the price to earnings ratio. Also this, you must have memorized the formula and you must be an expert in understanding where to find this in the balance sheet. You take the price, which is the stock market price of the company, and you divide it by the earnings, the price to earnings ratio. Okay, the last one it does not have here, but it's the PEG, the price to earnings growth. That means you take the two ratios, the price to earnings, and you see how much they change from year to year. The second set of metrics. When you have a stock price, you want to understand what has been the performance of that stock market price in the short term, medium term, and the long term. So in the short term, in 3 months, it is down 3%, but in a 3-year period, it is up 72.98%. Now the question is, if we wanted to find the stock price easily, what is the easiest way to find the stock price of a company? We can simply find it everywhere. You do not need to pay for any special services, for any special. Google will give it to you today. So Google also understands that when people look for the stock price of a company, there is a logical progression in the mind and for investors from 1 day to 5 days. We can look back at our presentation and we will see that the stock price for Google has changed from $96 in 2012 to $208 today. But the question is, what journey did it have? Was it a straight line? Did it go down first? Did it go up first? What is the name of this process of moving up and down from one point in time to another point in time? What is the measurement name for this movement? Begins with the letter V. Volatility. Volatility. So we need to understand the volatility of this market. So we look at the price over 3 months. It's moved between 206 and 214. In 6 months, it's moved from 195 to 206. YTD. What does the expression YTD mean? Year to date, which means we start at January the 1st until October 21 today. It's moved from 180 approximately, 176. 1 year. Similar, but in 1 year it's moved from 166. 5 years. Has the growth been good? Yes. It's moved from 191 in this case to over 200. So it has doubled in value. So the process I've just taken you through, it's evaluating the stock price on a multi-time frame basis. If you were to evaluate the stock price on this date here, when the stock price reached 100, and you were trying to make a forecast in 2015 of this company, how would you do it if you have the question in the examination? Dear student, it is 2015. Here is the information about a company. Please make a valuation of how much this company will be worth in 3 years' time. How will you do it? With some simple data like this. You will say, I will make the assumption that every year this company has earnings of 527 per share, which means that I have to assume for the next 3 years the same kind of earnings will continue. I will say that the growth of the earnings will be 15% every year. So I take this number, this earnings per share, 527. I multiply it by 15%, which is approximately 500, 10%, 50. 5% of 500, 250, 750, 750, 75. 75 plus 527, 602. You also will do this calculation in your head. 602. 527, earnings go to 602. Another 15%. So 600, 15%, 90. So 527, 602, 690. 3 years of earnings. 527, 602, 690. But I cannot add the numbers up. Why? Because the money that I receive in 2022 is not the same value as the money I have in my pocket today. Why? What is the difference? If I take out, I take 20 euros today and I go to the shops and I spend the 20 euros. You think in 2022, if you want to buy some nice English chocolates after Brexit, it will still cost you 20 euros? No. Why? Because if Brexit happens without a deal, it would be maybe 40. It's going to be expensive because there will be a tariff. Who knows? Could be it's less, could be it's 15. We don't know. But money has a value that is different in time for different reasons. Also, you have the problem of inflation. Inflation is the change of the value in time. So the price of a loaf of bread 100 years ago was maybe just a few lira, a few old lira. Today is maybe 50 times the price. So you take these three numbers. Question for you, do you remember the three numbers? What were the three numbers? 527, next number. 602, next number. 690, okay. And then we multiply them by the DCF formula. You want to do that in your mind now? No problem. We say the discounted cash flow is 3%. So in your examination, you quickly say, you draw a table. You make 3 lines. You put the box on the top. 2019, 2020, 2021, 2022. You put the next line, 3%, 3%, 3%, 3%. You do the calculation. What is this? You do the formula. 1 plus interest rate power of n divided by the denominator. You quickly do this in the examination for all of the years. You add up all of the cash flows for each of the years. You come up with the results. Alternatively, you can use a more complex formula. But the answer is, if you do not remember the formula, you cannot pass the exam. You will have to do it my way, and it will take you too long. Imagine they tell you, please tell me the result in 2075. What, you will go in the exam and write 75 lines and calculate each one? You'll be there till tomorrow. You must memorize the formulas. Okay, the next section. What is the gearing? The gearing is telling you how much leverage there is in a company. This means how much money did the company borrow compared to its assets. Okay, let's look at some other statistics. We can look at the okay. We can look at all right. We have the quick ratio and the current ratio. The cash flow, turnover, dividend yield, interest cover. All of these formulas you must learn. I won't cover them today because they're very easy. For example, interest cover simply says, if you make a loan from the bank, if my company is worth 100 million and I make a loan and the loan is for 5% of the bank. So this is 5 million. This is what I borrow from the bank, 5 million. But the loan is for 100 million. The interest cover simply says from the profits of the company. If the company is making 10 in profit and the loan was 5, that means the profit of 10 divided by 5 will give a ratio of 2. Your interest cover is 2. This means that the profit of the company will cover the interest by a factor of 2. So learn all of the ratios and put them in your mind, because this is the kind of thing that I would expect you will find in your examination. And then beyond that, there are some more complicated ratios, but we will ignore them. So if we say that we're looking for alternative metrics, here is a good example. McDonald's. In 1968, is this a good company? We can check the statistics. I'll read this for you because it's small. Over 4 billion served hamburgers. And we go to the next year, the same company, McDonald's, over 9 billion served in 1969. Is this a good result for the company? For sure. So Warren Buffett simply understood that one day even Italians will abandon pizza and begin to eat hamburgers. The British will abandon eating fish and chips. They will eat hamburgers. It doesn't matter where you're from. You simply abandon what you're eating and you begin to eat hamburgers. So it's a very simple process that you will learn. Okay. The last one, you must learn to think in probabilities. He was wonderful at playing bridge or games that calculate the idea of probabilities. So what is the probability when you look at the stock market? Heads and tails, prices rising and falling. What is the relationship? Does it matter if the price goes up or it goes down? Warren Buffett said, no. If I understand the market and the company, if I think that McDonald's is a great company, it does not matter too much about the price I pay today, because when I sell in 15 or 20 years' time, in a long period of time, my discounted cash flows, my stock market evaluation of the company, the capital asset pricing model that will establish where the company is amongst other companies and in the curve. I understand all of these factors and I take a fundamental approach to investing. And this is an example of his top 15 holdings. Big names: Coca-Cola, American Express, Johnson & Johnson, Walmart, Conoco, Washington Post, Moody's, Costco. Very big company names. Examples of some companies he sold. The last one, the last point we will finish on, is that he ignores market forecasts. He ignores what people tell him because the rule is, very simply, you must do your own research. Now, you can read everything you want to about Warren Buffett because he is completely transparent. If you spend the time to read his website, his company website, Berkshire Hathaway, you will go to his website, and then on his website he produces an annual report, and you will be able to see all the reports and the letters, and he will write a letter to all of his shareholders in public and tell you what he is doing in the market. And there is a record of all of these letters to the shareholders. And inside this, and it goes back a long period of time. And I would suggest, if there's one thing you do in life, learn from the best. People who have proved they can do it. They have a strategy which works and has worked in good times and bad times. And he will write in this letter a very detailed analysis of what he did, why he made his decisions, what happened in the companies, what happened with the earnings. And it's really a wonderful way to learn the practical application of the formulas in real life from someone who spoke it very honestly. And with that, I leave you with the very last thought that he wrote. Even though he said all of this, he said, I measure success by how many people love me, and the best way to be loved is to become lovable. And the nicest way to become lovable is to share what you do and tell people what you do honestly. So I like the guy. He's nice in a financial perspective, and he also has a nice philosophy and a nice way in life.